Hello and welcome to a special edition of Market and Macros. And who better than Chetan Ahya, Chief Asia Economist at Morgan Stanley, to talk about the state of affairs when it comes to the world economy in these changing and tumultuous times. Chetan, so good to have you on ET Now. Thanks for your time.
My pleasure to be with you.
Right. Chetan, obviously, let's talk about the elephant in the room, the tariff impact, right? And everyone's trying to grapple with what kind of impact it's going to have on India, Asia. And let me pick up on Asia. And I was scanning through your reports, which are forecasting a 120 basis points slowdown in Asia's GDP growth on a year-on-year basis. Tell me a little bit more about how the key transmission channels through which tariffs are expected to impact trade, corporate confidence, and of course capital expenditure. How are they going to pan out in the entire region?
So, the key framework that we are operating with is that unless there is a quick deal between US and some of the big trade partners like China, I would say put it in the next 4 to 6 weeks. The biggest issue that this whole trade tensions is going to do is to have a significant negative impact on corporate capex. And I'm drawing a bit more from my 2018-19 experience when tensions were only between US and China, but capex decisions were put on hold by all the companies across the world. So it wasn't just companies in US or China, but also in India, in rest of Asia, in Europe, and other parts of the world. So something similar is probably going to happen unless we have a quick solution on some of the large trading partners with the US and get a complete clarity on the path of tariff going forward. So since we are not expecting that, we are building in a significant slowdown in global capex, which then transmits to Asia in form of lower exports and additionally causes further slowdown in the region. So that's the key basis on which we have shown this path of Asia's GDP growth slowing from 4.8% that it was in fourth quarter of 2024 to 3.6% by fourth quarter of 2025.
Let's try and dissect what it is going to mean region by region. And it seems that the big fight, Chetan, is between the US and China, right? When it comes to trade negotiations. Let's try and play good cop, bad cop here. A, do you think if it's going to be all truce, is it going to work out, reducing tariffs from those prohibitive levels of 145? Are they going to really work? And if so, how much are they going to be pegged down to? And also, do you believe that, once these negotiations do get triggered, what perhaps could be the biggest risk to achieving a comprehensive deal?
So we think that, initially what you could see in the next, 2 months, we are expecting that by end of June, the US would take out the tit for tat tariffs and take down tariff rates, which on a weighted average basis currently is at 107%. Yes, the headline is 145, but remember that some of the products were exempted, like electronics exports. So currently, weighted average tariff on import from China is at 107%. That will, in our view, go down to about 71%. 71% is made up of 60% from this round and 11% from 2018-19 tariffs, which are still existing, by the way. And so, yeah, we will see that one level tariff reduction that the US will take up. And that will be potentially timed along with the start of the talks between the two governments. But we will not still see full tariffs being removed. We expect that tariffs will be further reduced to 45% by December 2025. But it will still be at 45%. And so from the perspective of the corporations, this tariff uncertainty related to China will not be going away anytime soon.
Interesting. Chetan, also, we've really seen things evolve when it comes to tariffs, right? From April 2nd, when the announcements first came in. From country-wise, it's now moving towards sectoral. And you highlight this in your report as well, especially especially about the uncertainty around sectoral tariffs, particularly when it comes to semiconductors and pharma. And I ask pharma because, that's where I guess India plays a very big role. Tell me, how do you assess the likelihood of these tariffs being implemented, and which Asian economies you think are most vulnerable to sector-specific disruptions?
So we are still going to see tariffs on various sectors. The administration has, in the U.S. administration has already indicated that some of the sectors, they think that they need to sort of take extra effort to onshore production. And auto and pharma are the two big ones. Semiconductor is the other one. And so these tariffs are still in pipeline. In terms of implications, autos will be and semiconductors will be more affecting Korea, Taiwan, and Japan. And in case of pharma, it will be India, China, and Japan. So these three will be exposed to that pharmaceutical tariffs. We will see whether there are some exemptions drawn within the sectors as well, because we've seen that overnight they have given some exemption to tariffs on the components, auto components. Not directly, but indirectly, there will be a sort of offset provided to the extent of a small proportion of the overall value of automobiles will be given as an offset for tariffs on auto components. So we'll have to see whether they do something like that for pharmaceutical, where they would sort of make a call that some of the generic drugs are essential, and it's probably worthwhile putting a lower tariff on that or not putting any tariff. So there is still some uncertainty on that. But we do think that the sectoral tariffs will also be there, at least on a headline basis.
Tell me, how do you think the entire, China story is actually going to play out, considering it seems that the big fight is between US and China? While the growth numbers so far seem pretty okay, and I'm sure that China is going to try and, stimulate the economy as much as possible. But how do you think China is actually going to counter and react to the tariff implementation? Because up until now, it's really been a tit for tat kind of story.
Yeah, so look, I think we do expect China to take up meaningful fiscal expansion. So they will increase their expenditure by about 3.5 trillion RMB in this year, which would be about 2.5% of GDP. So that's a sizable stimulus that they will take up. But to the extent to which the damage will be quite significant, not only because of exports, but also their own domestic private capex cycle, we are still building in a 170 basis points slowdown in China's growth rates, from 5.4 to 3.7 by fourth quarter of this year. So 5.4 was in fourth quarter of 2024. It will slow down to 3.7% by fourth quarter of this year. And in terms of the distribution of that stimulus, we're expecting 60% of it will be targeted towards pushing in more investment, and 40% of that stimulus will be targeted towards consumption. So yeah, I think it's going to be meaningful, but it will still not be able to avoid this big slowdown that will come through.
Chetan, I'm curious to know, what high-frequency indicators are you monitoring closely? Because one of your report does highlight that there's already been a sharp decline in the US-China trade activity, about a 33% year-on-year drop already in the cargo-carrying container ships. And also, how reliable are these high-frequency indicators when things are so much in flux right now?
Yeah, I think that there is a lot of uncertainty around the reliability of that data, because, like, for example, you mentioned about the container traffic, but we also look at this data on shipping activity, which is called as port calling data. It's number of ships at the port, in and out, loading and unloading. That data is actually showing that for India and Asia ex China, there has been quite a nice rebound in that shipping activity. It's sort of growing at now around Asia ex China in aggregate is growing at about 5% year on year. That is where it was before April 2 tariffs. So during the period immediately after April 2 tariffs, it came down quite sharply, but it's now back up. But I would caution against that number saying that everything is back to normal because there is a large amount of blank shipping or empty ships that have been moving around, and that data is available separately. That number has gone to a new high right now. Also, that we don't know the capacity utilization within ships. So I would just be a bit careful to think that everything is back to normal. And also, from a framework perspective, what we have been saying is that there will be eventually the negative effect of this capex slowdown. And in 2018-19, from the time tariffs were imposed, it took about 4 months to show up for it to show up in the hard data, which is the capex data. And for tracking capex, we will be using monthly capital goods imports data that comes out from the trade data in Asia. And as you know, Asia trade data comes out much earlier than US and Europe. So we think that could be a nice live barometer of what's happening in the capex cycle. And so for the month of April, we will know the data by middle of May. Similarly, May will come to know by middle of June. But our current assessment is that June hard data point, considering that will be 4 months from the time tariffs would have been imposed, should show that meaningful slowdown in capex data.
Interesting. How effective then, Chetan, do you think monetary easing, which pretty much most central bankers other than the Fed are adopting so far, how effective is it going to be in offsetting the growth drag from tariffs?
So just as I mentioned for China, we will see monetary easing for Asia ex China. So the way we are thinking about it in terms of policy response is that China, since its interest rates are relatively low, will have to rely more on fiscal easing, whereas Asia ex China, we think is going to be held back a bit in using fiscal policy aggressively since public debt to GDP ratios have moved higher. Fiscal deficit has also not all countries have not seen fiscal deficit come down to pre-COVID levels. So they will be relying more on monetary easing. And so we are expecting meaningful monetary easing across the region. But just in case, as I mentioned, in case of China, policy easing will be an offset, but it will not be able to still avoid, the region will still not be able to avoid a meaningful growth slowdown. And for India specifically, we are building in another 50 basis points of rate cut. And yet India will also see its growth slow down from 6.2% in fourth quarter of 2024 to 5.7% in fourth quarter of 2025.
So other than central bank action, Chetan, which we've already seen in terms of rate easing and even the liquidity push to the banking system from the central bank, what other tools do you think the government has currently available to try and pump up the economy?
So look, from the central bank perspective, tariffs are deflationary. To the extent to which it is slowing down global trade, global commodity prices have also softened, and it will affect capacity utilization in India. It will affect capacity utilization of the manufacturing sector across the region. So there will be disinflationary pressures emanating from the region. There will be domestic disinflationary pressures because of decline in capacity utilization. So I think it's relatively easy for the central bank now, and we had some supply constraints on food sector, and food inflation was high. That's also now come back below 4. So we think the central bank will be able to take adequate monetary easing to support growth. We are expecting that central bank will take up liquidity injections. It will cut interest rates. And as it's already started to do, it will take up some more regulatory easing as well. So on all the three fronts, you should expect the central bank should take actions. From the government side, my personal preference would be that they kind of defer the consolidation of deficit. Right now, we are still building in fiscal consolidation because that's what the finance minister has repeated. But I think to the extent to which there will be some loss of revenue with growth slowdown, if the government decides to still be on the consolidation path, it will have to then come out at the cost of reducing expenditure or expenditure growth. It would be better to keep capital expenditure growth strong to offset this downside pressure from external demand slowdown and potentially private capex slowdown.
Chetan, you've also warned of potential spillovers, right? Such as weaker job creation, suppressed consumption, and interestingly and intriguingly, banking sector risk aversion as well. Tell me which Asian economies, and if you think India is also part of that pool, are most at risk of these non-linear effects, and how might they manifest themselves in the latter part of the year?
So, in general, the approach that we have taken is to just look at goods exports to GDP. And because, as I mentioned earlier, it's not about, bilateral issues that any country has with the US. There's going to be a global capex slowdown. There's going to be a global trade slowdown. So, best parameter to watch would be who is more exposed to global goods exports. And so therefore, we look at exports to GDP ratios. And on that parameter, India has the lowest goods exports to GDP at 12%. And some of the mid and smaller size economies in the region, which is the likes of Korea, Taiwan, Thailand, Malaysia, they will be relatively more exposed. China's goods exports to GDP is at a moderate level at 20%, but China has a very high dependence on net exports for its GDP growth. For instance, in the first quarter of this year, they just reported that 40% of their growth came from net exports. Last year, fourth quarter, it was 45% of their growth coming from net exports. So we overlay exports to GDP ratio with the dependence on net exports. And since India is sort of running modest current account deficit, it's less reliant on net exports as well as a big driver to growth. Whereas China, we kind of add to that list of economies which will face significant downside pressures in this environment of trade tensions.
Chetan, you've also talked about a quick resolution of tariff uncertainty, and that could bring upside risk to the growth outlook as well. Tell me what a quick resolution is going to look like in terms of timelines and tariff reductions, and how much could it realistically boost then Asia's GDP growth in 2025?
So, we were building in some slowdown, but, we've additionally cut growth rates by about, 50 to 70 basis points, depending upon the economy in the region, on account of these last round of trade tensions, which were basically taken up on April 2nd. So if you now see a complete reversal of that in the next 4 to 6 weeks, as I was mentioning earlier, then you could sort of go back to the original path that we were forecasting. But it's still going to be very optimistic to assume that there is going to be a complete reversal, and in 4 to 6 weeks' time, we are back to where we were before April 2nd.
And specifically on India, Chetan, you just highlighted as to how India is still sort of isolated and cocooned from the impacts of tariff implementation. It seems that India perhaps could be the first country that there could be a tariff handshake on when it comes to US. Tell me, what is your standalone view on how India's economy has been, what the Reserve Bank has been doing in trying to combat and control inflation, at the same time try and instill growth as well?
So we think India is doing well on a relative basis, but look, on an absolute basis, everybody is going to take some pain. And so, as I mentioned, for India, we are building in a 50 basis points growth slowdown from 6.2 on a quarterly trajectory to 5.7 over the 4-quarter period. So that is going to be still, something that cannot be avoided because India is still sitting in this world, connected with the rest of the world. The part that is good in India is that there is a structurally higher dependent on domestic demand versus external demand. And at the same time, there was a bit of a blip in the government spending because of elections last year. That has come back. So the support from government spending is going to be quite critical in this environment. And so hopefully we don't see a compromise on those target numbers that were laid out in the budget on capital expenditure. But so I think, yeah, India's domestic demand dependence is high, and that is on a structurally higher path. So that's going to be an offset. But net, because of this challenge on external demand from trade tensions, India's growth will also moderate.
Okay, interesting. Chetan, so good chatting with you today and covering all aspects and how this 90-day period is actually going to turn out. And we'll chat again soon once we have this, 90-day period out of the way and at least some visibility or clarity on how and how much it's going to impact the world economy. Good having you on the show today.
My pleasure.
Okay, on that note, we'll take...